Welcome to Austrac's Customer Due Diligence Essentials series. This series explores one of the key components of Australia's anti-money laundering and counter-terrorism financing regime, understanding who your customers are. We'll start by outlining what Customer Due Diligence, or CDD for short, is. We will then look at its purpose and the different forms it takes, before exploring how to assess and rate customer risk and examining key terminology and concepts to help you better understand your customers. The information presented in this video is current at the time of recording, is general in nature, and does not constitute legal advice. You may consider obtaining your own independent professional advice, which can take into account your business's specific and individual needs. This content is at an introductory level, and more detailed information can be accessed on the Austrac website. We will use examples and explanations throughout the video to clarify various terms that you will see used under the AML-CTF regime. These have been simplified for introductory purposes and do not comprehensively define each term or scenario. By the end of this video, you'll be equipped with the knowledge and confidence to navigate the essentials of CDD. First, you'll be able to identify and describe the key elements of CDD, including the different types of CDD and when they are required. Then, you'll be able to explain the purpose of CDD in identifying, mitigating and managing money laundering, terrorism financing and proliferation financing risks. These are referred to as MLTF risks. You will also understand how to assess and rate customer risk. You'll be able to define the essential terminology and concepts used in CDD. And finally, you'll be able to identify practical steps to start preparing your business now to meet your CDD obligations. Let's get started by exploring customer due diligence. CDD is your process for understanding who your customers are, both before you start providing them with a designated service and continued throughout the course of your business relationship. CDD is more than a regulatory checkbox. It's a critical safeguard for your business that serves three key purposes. First, it helps you establish your customer's identity, who they are, who they represent, and whether there's any legal reason you shouldn't be providing the service they've requested. Second, it enables you to identify and assess MLTF risks involved in providing a designated service to that customer. Customer due diligence helps you determine whether a customer is too high risk for your business, or whether there are controls that you can put in place to manage and mitigate the risks effectively. Finally, it ensures you gather the right information to make the required reports to Austrac. These reports support law enforcement and national security investigations, helping detect and disrupt criminal activity in Australia and around the world. Now that we've explored what CDD is, let's look at the obligations that sit behind it. Your AML-CTF program must include policies outlining how you will conduct CDD. This includes how you'll meet your AML-CTF requirements for CDD and how your customer due diligence processes will help you mitigate and manage your MLTF risks. The CDD measures you take must be appropriate to the level of MLTF risk your customer presents. These measures should be targeted to the risks of the customer and the services you provide them, proportionate to the level of risk, effective at managing and mitigating those risks in practice, and ongoing where necessary so you can monitor, mitigate and manage the customer's risk throughout the business relationship. Now let's look at the four distinct forms of customer due diligence. The first form of CDD is called initial customer due diligence. This must be completed before you begin providing a customer with a designated service. It involves identifying your customer and any other relevant parties and assessing their MLTF risk. To do this, you collect and verify Know Your Customer or KYC information that establishes on reasonable grounds who the customer is and the nature and purpose of the business relationship. For example, you might be able to determine whether a customer is a politically exposed person or subject to targeted financial sanctions. Establishing a customer's source of funds and source of wealth is also part of determining the risk they pose. We'll discuss these terms in further detail later in the session. The type of information you collect will depend on the kind of customer you have. It must also be appropriate to their level of MLTF risk. Initial customer due diligence helps you establish on reasonable grounds your customer's identity, assess whether the customer is low, medium, or high risk, and decide what further steps you need to do to manage and mitigate the MLTF risks in providing that customer with a designated service. The second form of CDD is simplified CDD. This may be applied to customers who present a low level of MLTF risk and don't require enhanced CDD measures. If you offer simplified CDD, your AML-CTF policies must outline your simplified CDD measures. Under simplified CDD, you can collect and verify less information than you normally would need to under initial CDD, provided you're satisfied on reasonable grounds that the customer's risk is low. Once initial or simplified customer due diligence has been conducted, you must monitor your customers to identify, assess, manage, and mitigate the MLTF risk you may reasonably face while providing the designated service. This third form of CDD is called ongoing customer due diligence. You do this by keeping their KYC information up to date, including re-verifying it where appropriate, watching for suspicious activity, updating their risk profile when needed, and collecting further information when appropriate. In some circumstances, simplified CDD measures may also be applied during ongoing CDD. The final form of CDD is enhanced CDD. This involves taking extra steps where customers present a higher MLTF risk. Some examples of this include, but are not limited to, a customer located or formed in a high-risk jurisdiction, a customer or their beneficial owner being a foreign politically exposed person, and when a suspicious matter report is triggered due to unusual account activity. These enhanced measures may be required during initial checks, ongoing monitoring, or both. You can find further guidance on the different forms of CDD on the AUSTRAC website. Part of your initial and ongoing CDD obligations involves understanding the MLTF risk that your customer may pose. This is known as customer risk. Assessing customer risk is different from your broader MLTF risk assessment, which looks at risks across your entire business and customer base. Customer risk focuses on each individual customer's level of MLTF risk. As part of this process, you assign each customer a risk rating that indicates whether they present, for example, a low, medium, or high risk to your business. Your initial assessment will be based on the KYC information reasonably available to you during initial CDD before you start providing a designated service. Your assessment of the customer's risk rating should be updated based on any new information identified through ongoing CDD. Understanding your customer's level of risk helps you apply your AML-CTF policies appropriately to mitigate and manage those risks. It also helps you determine when you can apply simplified customer due diligence for low-risk customers and when you must apply enhanced customer due diligence for high-risk customers. To apply customer risk ratings consistently, your business needs a clear method for how these ratings are determined and recorded. This method should be documented in your AML-CTF program and form part of the policies and procedures your staff follow when assessing customer risk. When developing your customer risk rating method, consider the factors that influence risk. These can include the type of customer you're dealing with, for example, an individual, company, or trust, the designated services you will provide that customer, the delivery channels the customer will use, such as face-to-face, online, or through an agent, and the countries involved in transactions or business relationships. For example, where your customer is located or where funds or services will be sent, received, or conducted through. Your methods should guide staff to use these factors to determine whether a customer poses a low, medium, or high risk of money laundering, terrorism financing, or proliferation financing. It's also important that your customer risk rating method is appropriate to the nature, size, and complexity of your business, and that your staff can apply it consistently. This will help ensure that every customer is rated using the same method, and your AML-CTF program accurately reflects how you assess and manage customer risks in practice. To help you think about what different levels of customer risk might look like in practice, let's run through a few simple examples. First, low-risk customers. A low-risk customer is typically an Australian resident seeking a low-risk service that only involves interaction with low-risk jurisdictions. For example, an Australian resident who isn't using a representative and wants to access a service you deemed low risk when completing your broader MLTF risk assessment. Next, medium risk customers. These customers may have some features that increase their risk and may have a moderate impact. For example, these customers may request a service you have assessed as medium risk, have links to medium risk jurisdictions, are low-profile domestic politically exposed persons, or are non-individuals with a multi-layered control structure that isn't overly complex. In these cases, you will need to assess whether there are any red flags or enhanced CDD triggers present with the increased MLTF risk. Finally, high-risk customers. High-risk customers show stronger indicators of risk or complexity and will require enhanced CDD. For example, they might be a non-individual customer with a multi-layered and unusually complex control structure, be a foreign politically exposed person, have ties to high-risk jurisdictions, or request a service that doesn't have a clear lawful or economic rationale. Again, it is important to note that these examples are only a guide and are not exhaustive. Your approach should always be based on your business's broader MLTF risk assessment. Now that we understand what customer risk ratings are and how to approach ratings, let's look at what to do during initial customer due diligence. During this stage, your customer's risk rating will be based on the information you reasonably have available to you before you start providing a designated service. This KYC information helps you understand who your customer is and establish the level of MLTF risk they present. KYC information may come directly from the customer, such as a driver's license showing their name, address, and date of birth. It may also come from other independent, reliable sources. For example, online checks confirming their Australian company or business number, or whether they are a politically exposed person. You can assign a customer risk rating during initial customer due diligence by using a process like the following. First, you must determine what information is usually reasonably available before you start to provide a designated service. This is information you could collect and verify to do all of the following. Satisfy on reasonable grounds the required matters for initial CDD, initially identify your customer's MLTF risk, and determine if enhanced CDD applies based on your customer's MLTF risk. Second, collect and verify this information provided by their customer or their representative through an onboarding process along with any reliable and independent documents needed to verify it. Third, using this information, conduct your initial assessment of the customer's MLTF risk using your established risk rating method. Fourth, based on that assessment, determine whether you need to collect and verify any additional KYC information based on your initial identification of the customer's MLTF risk. Finally, collect and verify sufficient information to establish on reasonable grounds each of the required matters for initial CDD. We expect your AML-CTF policies to determine what additional information you need to collect and verify based on the customer's MLTF risk. When high risk factors are present, your customer's overall risk rating will inform the KYC information you need to collect and verify for initial CDD. It will also shape how you monitor the customer for ongoing CDD. Where initial CDD focuses on identifying your customer before providing them with a designated service, ongoing CDD focuses on monitoring them throughout your business relationship. You must continue to monitor your customer for anything that might change your identification and assessment of their MLTF risk. This helps to ensure you are appropriately managing and mitigating that risk over time and reassessing your customer's risk rating when their circumstances, transactions, or behavior change. You must also monitor your customers for unusual transactions or behavior. This includes any activity that could require you to submit a suspicious matter report to AUSTRAC and may also prompt you to reassess the customer's risk rating. For example, you might notice transactions that don't make sense given what you know about your customer, such as high-value transfers, payments to new third parties, or activity with no clear lawful or economic rationale. These could indicate that your customer's level of risk has increased and should trigger a reassessment of their risk rating. You might see transaction patterns that appear designed to avoid reporting to AUSTRAC, such as splitting cash deposits or withdrawals into smaller amounts below the $10,000 threshold for threshold transaction reports. This behavior may suggest the customer is attempting to conceal activity and may prompt you to reassess whether they continue to present the same level of risk. Sometimes a customer's behavior itself can be a warning. For instance, if they refuse to provide information you request for ongoing CDD, or if they avoid answering questions about their transactions or business activity. These situations may warrant a reassessment of the customer's risk rating, as their unwillingness to engage may increase their risk profile. Your ongoing CDD process must form part of your AML-CTF policies. You must also comply with your record-keeping obligations and keep records showing how you complied with your ongoing CDD obligations in relation to a customer. We will discuss this in further detail in CDD Essentials Webinar 2. Keeping records helps you comply with the law and demonstrate to AUSTRAC that you're meeting your AML-CTF obligations. Good record keeping also protects your business. If your services are ever misused for money laundering, terrorism financing, proliferation financing, or other serious crimes, your records can help AUSTRAC and other authorities investigate. Record keeping means creating clear, complete, and accurate records and keeping them for a set period, usually 7 years. With regards to customer due diligence and risk ratings, you must make and keep records of the customer information you collect and how you verify it, how you identify and assess customer risk, the decisions you make regarding customer risk, and your reason for making them, as well as key outcomes from regular reviews and monitoring activities. These are just a few examples. For more information about customer risk ratings and record-keeping requirements, visit the AUSTRAC website. Now that we've looked at how to assess and rate customer risk, we'll take a step back and explain the common terms used to describe customers and your CDD requirements. We'll look at different risk indicators, including politically exposed persons and persons designated for targeted financial sanctions. We'll also explore different customer types and beneficial ownership before moving on to financial transparency concepts like source of funds and source of wealth. A politically exposed person, also known as a PEP, is someone who holds a prominent public position in a government body or an international organisation. This term also applies to their immediate family members and close associates. Because of their position and influence, politically exposed persons and their associates may pose a higher risk for money laundering, terrorism financing, or proliferation financing. Their public status makes them targets for bribery, corruption, or other forms of financial abuse. You must establish on reasonable grounds any PEPs relating to a customer before you start providing the customer with a designated service. There are 3 types of PEPs: foreign, domestic, and international organisation. A foreign PEP is someone who holds a prominent public position or office in the legislature, executive, or judiciary of a foreign country. Examples include a head of state, high commissioner, ambassador, high-ranking military officer, and other positions. A domestic PEP is someone who holds a similar position in Australia. Examples include a member of parliament, a senior government or political party official, the governor of a state, or a justice of the High Court. An international organisation PEP is someone who holds a prominent or senior role in a public international organisation, such as a head, deputy head, or board member of an organisation like the United Nations. Family members and close associates of these individuals can also be PEPs and can include people with joint or sole beneficial ownership of companies or arrangements linked to the PEP, or those with close business relationships with them. You can identify if someone is a PEP or a relative or close associate in a few ways, which will depend on the size, nature, and complexity of your business. Examples include asking customers during onboarding if they, a family member or a close associate, hold or have held a prominent public position. You can also check sanctions lists, government publications, and reliable news sources, or use third-party databases that help identify political exposure or corruption risks. It is also important to conduct checks throughout the relationship with your customer, as their circumstances may change over time. Let's look at what identifying a PEP might look like in practice. Jackson Smith & Partners is a law firm that handles property transactions for foreign investors. The firm is approached by a new client wanting to purchase an inner-city apartment block. During initial CDD, the principal lawyer, Melanie, identifies the client as a foreign PEP because they hold a position as a foreign government representative from a high-risk jurisdiction. This triggers a requirement to conduct enhanced CDD. Although the client's source of funds and source of wealth appear legitimate, Melanie discovers adverse media coverage linking one of the client's family members to a property scam. She escalates the matter to senior management, who recommend not proceeding with the engagement, and then documents all steps. You must get senior manager approval to provide a designated service and continue a business relationship with a foreign PEP, or if a domestic or international organisation PEP has a high MLTF risk. Just as it is important to understand PEPs, it is equally important to understand targeted financial sanctions. Targeted financial sanctions are legal measures that prohibit dealing with certain individuals or entities named or designated under Australian sanctions law. Targeted financial sanctions can include freezing a designated person's assets or prohibiting others from providing funds, goods or services to them, either directly or indirectly. Your AML-CTF policies must explain how your business will ensure it does not directly or indirectly make any assets available to or for the benefit of a person or entity designated for targeted financial sanctions. You must also ensure that you do not use, deal with, or allow someone else to use or deal with any assets controlled by a designated person or entity. Before providing a designated service, you must establish on reasonable grounds whether your customer or anyone acting on their behalf is designated for targeted financial sanctions. To do this, you can use the consolidated list published by the Department of Foreign Affairs and Trade. The consolidated list is updated regularly with individuals and entities subject to Australian sanctions, with some details such as aliases, dates and places of birth, citizenships and addresses. Breaking Australia's sanctions law can be a serious criminal offence. Penalties of up to 10 years imprisonment and significant fines apply for a breach of these laws. You can subscribe to the Department of Foreign Affairs and Trade's mailing list to be notified of updates to the consolidated list. You should also refer to the guidance on targeted financial sanctions available on the AUSTRAC website. Let's now look at types of customers. As part of initial CDD, you must identify your customer. This includes whether they are an individual or a non-individual customer, such as a company, association, or trust. Doing business with non-individual customers carries different risks to doing business with individuals. Non-individual customer types may have more complex ownership structures. Understanding who your customer is and who ultimately owns or controls them plays an important role in detecting, disrupting and preventing money laundering, terrorism financing, proliferation financing and other serious crimes. This leads us to beneficial ownership. A beneficial owner is the individual or group of individuals who ultimately own or control an entity such as a company, trust or partnership. Own in this context means holding 25% or more of the entity. This ownership can be direct, such as holding shares, or it can also be indirect, such as through another company, trust, or investment arrangement. Control means having the power to make decisions about the entity's finances or operations. Control can be exercised through trusts, agreements, arrangements, or other practices. Your obligations around beneficial owners include determining who your customers' beneficial owners are, assessing the level of MLTF risk those beneficial owners pose, including whether they are PEPs, linked to higher risk jurisdictions, or persons subject to targeted financial sanctions. You're also obligated to verify the identity of each beneficial owner and keep records of how you identified and verified them. To work out who really owns or controls a company, you need to look at both direct and indirect ownership. You must establish how your customer is owned, controlled, and managed. The following is an example of determining the beneficial ownership of a company. John, the sole director of Greenpath Holdings Co., visits Somerset Bank to open a business transaction account for the company. As part of initial CDD, the bank identifies John as the authorised agent and requests identification documents for him, along with company documents showing Greenpath's corporate and ownership structure. The documents reveal that White Roads Pty Ltd is Greenpath's sole shareholder. Somerset conducts current and historical ASIC searches on both Greenpath and White Roads, discovering that Yellow Steps Pty Ltd owns White Roads. Sarah is the sole director and CEO of both White Roads Pty Ltd and Yellow Steps Pty Ltd. Further ASIC checks show that Sarah owns 76% of Yellow Steps Pty Ltd, making her the ultimate beneficial owner of Greenpath Holdings Co. Somerset contacts John to obtain Sarah's details and then asks her to verify her identity. Sarah provides her driver's license and utility bill, which the bank successfully verifies using the government's document verification service. Sanctions, PEP, and high-risk jurisdiction checks find no matches. Based on the ownership structure, Somerset assigns a medium MLTF risk rating and proceeds to open the account, uploading all verification documents and company extracts to the customer file. This example shows how beneficial owners can be identified through both ownership and through control, even when there are layers of companies involved. Identifying beneficial owners helps you see who is behind your customer, but it's also important to understand where their money comes from and how they built their wealth. These concepts are referred to as source of funds and source of wealth. Understanding a customer's source of funds and source of wealth helps you identify suspicious activity and meet your AML/CTF obligations. You must collect this information for high-risk customers, high-risk transactions or activities, and when a customer or their beneficial owner is a foreign PEP. Source of funds refers to how and where a customer obtained the funds used for a specific transaction. Verifying this information confirms that the funds come from legitimate activities and align with the reasons for and how the customer uses your services, including what you know about the customer's employment, business, and commercial activities. Source of wealth refers to the origin of a customer's overall wealth. It describes the economic, business, or commercial activities that contributed to their overall net worth. It helps you assess whether their financial activity is consistent with their background, what you know about them, and the expected use of the designated service. A source of wealth check may be appropriate if there is a doubt about a customer's overall financial background and how they accumulated their wealth. Examples of the kind of documents and data you might use to verify source of funds and source of wealth include personal income records such as bank statements, payslips, or tax returns, legal and inheritance documents such as wills, divorce settlements, trust deeds, or court orders, business and investment evidence like audited financial accounts, sale or purchase agreements, share registries, or royalty statements, ownership and transaction history including business ownership records, receipts, share transfers, or digital asset trades, and external verification sources such as searches of public registers, property, land, company, or written confirmation from a legal or financial professional. It is important to note that this list has been designed to guide your understanding only. It's not exhaustive, and what is appropriate will depend on the context and your business's broader MLTF risk assessment. A more comprehensive list is available on the AUSTRAC website. Before we move on to your next steps in the Customer Due Diligence Essentials series and where to get more information, let's review what we've covered in this video. We outlined what customer due diligence is and introduced its purpose and key stages of initial, simplified, ongoing, and enhanced CDD. We also explored how to assess and rate customer risk and explained key terminology and concepts to help you better understand your customers, including what a politically exposed person is and what targeted financial sanctions are. We also looked at different customer types like individuals, non-individuals, and beneficial owners, plus what source of funds and source of wealth are. Now that you have been introduced to customer due diligence, think about how you can put these concepts into practice. Understanding your AML/CTF obligations and preparing early will set your business up for success, particularly if you are newly regulated. There are resources available to support you on the AUSTRAC website. These include Reform Guidance, which covers a range of topics, including customer due diligence and customer risk ratings, an AML/CTF program quick guide, which breaks program requirements into simple, practical steps, including how to structure your customer due diligence controls. Customer due diligence is a key control that helps you identify, assess, manage, and mitigate MLTF risk. By understanding your customers and how they use your services, you can identify unusual or high-risk activity and apply stronger controls where needed. Implementing strong customer due diligence measures is essential to protecting your business, the financial system, and the wider community. Once again, we encourage you to start preparing now. This brings us to the end of this video. The Austrac YouTube channel has other videos available. If you are a new reporting entity, and if you haven't already, we recommend watching the AML CTF Essentials series. This is a series of 4 webinars designed to introduce you to Austrac, Australia's AML CTF regime, and provide the information you need to help you meet your new obligations. Thank you for viewing this Customer Due Diligence Foundations video.